Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Lance Roberts. Remember, new shows are posted every Monday and Thursday. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today I spoke with Lance Roberts, economist and strategist at Real Investment Advice. Quick background on Lance. He's been in the investing world for more than 30 years, from private banking and investment management to private and venture capital. Lance has a common sense approach that I really enjoy, and I know you will too. In today's show, Lance tells us what he thinks about the current economy and explains why he believes the market leads the economy. He gives us his thoughts on President Trump's comments on the Fed and how he believes the Fed is hiking us into a recession. Last but not least, Lance shares with us his process for building a strategy, from wearing his economist hat, strategist hat, and how he uses technical analysis. Without further ado, let me take you right to the interview with Lance. Lance, thanks for joining me.
Perfect. Glad to be here.
I'm glad to have you here today, Lance. Busy market, so thank you very much for taking the time to speak with me today. You wear two hats at your firm. You're an economist and a strategist. So I want to start off with you wearing the economist hat. How do you view this current economy?
Well, again, I look at the economy very differently than the majority of economists, kind of mainstream economists on Wall Street, which they look at economic data from 1 month or 1 quarter to the next, and they say, well, the economy was up 4.2% this quarter or 3.5%. It's great. We're positive. For me, that's fine. It tells you what's happening right now, but it doesn't tell the whole story. And particularly when it comes into managing money and developing a strategy, the economy is important, but it is a reflection of what is actually happening in the underlying world of the corporations that make up our economy. So in other words, this is why the market tends to lead the economy over time. I just did a report recently talking about how the stock market leads the economy and is really a very good economic predictor of even recessions, because of the interrelationship between what happens on the consumption-based side of the equation. In other words, what you and I spend in the economy from 1 month to the next is what determines economic growth. 70% of the economy is driven by consumption. Corporations are a function of that consumption. So the consumption equation ultimately comes down to the fact of, as long as we're buying and consuming, the economy will grow, but there's a point in time to where those will change. How do we know when that change is coming? Well, that's where a lot of the economists, in my opinion, go wrong, because they simply look at this month's number or this quarter's number rather than looking at the trend of the numbers over time. Are the trends of the numbers increasing or are they decreasing? And more importantly, what's driving that increase or decrease in the economy? So myself, right now, I'm not a huge proponent that we're going to have this booming economic growth for another decade going forward, as is expected by the CBO and by the Federal Reserve, that we're going to have another 10 years of 2% growth. The reality is that we're very long in this current economic cycle, and the bump that we've seen in the economy since really in the first and second quarter of this year has not come from Trumponomics or from tax cuts. Those are part and parcel of a lot of the lift that we got in the market. But the big driver of the economy has been the billions of dollars that have been invested into the economy following three major hurricanes last year, two major wildfires in October, September of last year. It takes time for that money, after those events occur, it takes time for that money that's invested to work its way through the economy. So we've seen a pickup in job growth where? In manufacturing and production side of the equations. We've seen a lift in commodity demand, not surprising. All that is now beginning to show early signs of fading because that cycle of rebuilding has now come to an end.
What you just said explains to me why so many economists can disagree. Because as a non-economist, right, as a trader, shouldn't there be some metrics that they sit back and say, okay, the economy is good or it's bad? Because I could listen to one news show where somebody will say the economy is great and then go to the next guest and they'll say the economy is not doing well. Mm-hmm. And just to go back and talk a little bit about what you said too many economists focus too much on the now versus the trend of the economy, and you believe the market leads the economy. So right now, we're seeing a market that is pulling back, that is going down. So what you're saying is that the market now going down, that we should start seeing the economic numbers start to follow. Am I reading that right?
You're reading it right to a point, but let's take this back to the beginning of this year. Now, as we speak right now, the market is pushing down to levels that we haven't seen since February of this year. Now, all that's happened so far this year is that we've consolidated a market that ran up in 16 and 17. Again, don't forget that back in 2015, 2016, the markets went through a double bottoming process and actually in 2016 had set new lows. And had it not been for the Federal Reserve and the ECB and the Bank of Japan and the Bank of England really coming into the markets with a tremendous amount of liquidity, that's what led to that post-Brexit concern, that rally in 2016 and 2017, where we saw the longest run of monthly gains in history with the lowest level of volatility. Now, all that's happened so far this year in 2018 has been volatility has returned. And of course, we've seen a lot of up and downs, but the market's potentially telling you two things. What the market's telling you right now is that a lot of the tax cut benefit, and we wrote about this in December of last year. We said that tax cuts are fantastic and they'll last for approximately 2 quarters. Beginning of the third quarter, you're going to start to see the effect of that tax cut benefit begin to fade away. And the reason is that we don't look at earnings from one quarter to the next. We look at year-over-year growth rates in earnings. So after 1 year of time, the growth rate in earnings are going to begin to decline because that year-over-year boost is going to fade off. So we're already starting to see now as we go into third quarter, and of course, we're also dealing with tariffs and trade wars. And we wrote about earlier this year that tariffs are a tax on corporations. It's a tax on consumers. You're going to see an impact from that. What are we seeing currently as we move into the third quarter of this year? We're seeing retail sales much weaker than expected in the latest report. And as we've moved into the third quarter's earnings season, what have we heard from corporations? Concerns over tax, repricing of expectations going forward in terms of earnings and revenue. Also, reconsideration of CapEx spending plans, investment plans, et cetera, because of the impact of tariffs. 38% of businesses in a recent survey said, hey, you know what, we're rethinking all of our CapEx because of these tariffs. So again, what we talked about early on this year is say, be careful with this idea of the tariffs and are great for the economy and the tax cuts are a permanent boost to the economy. Simply not the case. Those get factored in very quickly. In December of last year, we said that with tax cuts, the repatriation of dollars from overseas would be about $300 billion, not the $1.5 trillion expected. How much has been repatriated? Roughly about $300 billion. Where did it go? Exactly where we said it would, which was into tax cuts, into share repurchases, not really increases in wages.
A few things. We're going to talk about Fed and the Trump in just a moment, but I want to talk to you about just some of the basic data points that we as traders should keep an eye on for a gauge of the economy. What are those things we should be watching?
The most important thing to watch for in the economy right now is to look at employment and look at jobless claims. And why are those two the most important thing? there's a lot of other very important anecdotal points that that you want to be paying attention to. Take a look at what's happening with housing, take a look at what's happening with auto sales, take a look at what's happening with retail sales, because that's all consumption. And again, 70% of the economy is consumption. But if you want to know where the risk in the market is coming, particularly in the economy, keep a watch on employment and jobless claims. And the reason is that we are now at the lowest levels in history in these two indicators, right? 3.7, 3.8% employment, unemployment, of course, extremely low jobless claims. When those two begin to turn higher, and they will turn higher almost coincidentally together, when you begin to see those begin to tick up, those are going to be very early indications that the economy is starting to weaken and make a turn for the worst. And when they break their moving averages over 12-month periods, those are very early indications the economy is on verge of moving into a recessionary period within the economy. So those two are great leading indicators, but also the market will lead that turn by probably about 3 to 4 months.
So you've already mentioned Trump and the Fed, and obviously this is something that I think the market has seriously been taking a look at because the president talks about this so often, and he says that the Fed is just going loco. Those are his words, like it's going crazy.
Right.
What do you think about him saying that?
Well, I don't think that the president should be getting involved with monetary policy. There needs to be some independence of the Fed. Do I think the Fed's misguided in what they're doing? Yes, we can talk about that in a second. But I also think the president needs to stay out of monetary policy. There needs to be an independence between these two. And of course, the reality is, and you know this and I know this, is that there's really not. The Federal Reserve has always worked at the behest of politics to a degree, because in order to pass economic policy, in order to pass fiscal policy, you need a market that's working, and in order for people that are in power to stay in power, they need markets that are working. So, with elections that are coming up in November, this sell-off in October may have an impact on the actual election. People vote with their pocketbooks, right? People's economic outlooks is based on what's happening in the economy and happening in the markets. So when you're talking about record confidence levels, you're talking about record consumer confidence levels, record investment confidence levels, record business confidence levels. Well, that's all because we've had this boom in economic growth. A lot of it's been artificially driven by a lot of fiscal stimulus. So we're running nearly $1 trillion deficit in 2018. That will be $1.5 trillion moving into 2019. By the way, you only run $1 trillion deficits in recessions, not expansions, which tells you a little bit more about what's happening in the real economy. But secondly, the point is that you have those record confidence levels are what you see at peaks of market cycles, not the beginning of a market cycle. So the Federal Reserve potentially is operating in very dangerous territory by continuing to hike rates. They're trying to do that not because they believe the economy is going to be taking off onto a massive growth expansionary run. Their long-term estimates are 2% on economic growth. So at 2% economic growth, why are you hiking rates above that growth rate? Interest rates are a reflection of economic growth, period, right? You go back through history, interest rates in the 10-year Treasury run about the level of economic growth over time. So why on earth are you continuing to hike rates if you expect a 2% growth rate in the economy? Because the Fed knows, as well as you and I know, that eventually the cycle will end and we're going to have a recession, and their best tool for fighting a recession is being able to drop interest rates. They have got to get as far away from zero as possible in order to have that tool available. They understand that they're potentially hiking themselves right into a recession. The problematic issue with Trump getting involved is that if he stops them from getting as far away from zero as possible, it will limit the tools available for that recession when it comes.
So, and I agree with you on what you're saying. You're saying the Fed is hiking themselves basically into a recession. So this way they can potentially cut rates if we get into a recession. It just seems
right. You got to have it seems weird, but it's the lesser of two evils. If you have a recession at zero, right, then the recession is going to be really, really, really bad. I mean, we're talking about a depressionary type recession because there's no policy tool available for the Federal Reserve to use at that point. They don't have the ability to go to negative rates yet. That's going to require some congressional approval. And whether or not they'll get that's a different story, considering what we've got going on in politics right now. So their best bet is to get it far away from zero. It's the lesser of two evils. Yes, I potentially hike into a recession, but I have the ability to stave off some of the decline by having a tool available. They don't have the ability to do a tremendous amount of QE. The world expansion that's been done on QE has basically come to an end. So we're now in a contractionary basis on QE, which leaves that tool and the efficacy of that tool potentially at some risk.
We talked a lot about your view on the economy. So now I want to put the strategist hat on, because this is where I think it gets very interesting to me as a trader, because you understand the economy extremely well, but now you have to build a strategy to execute what you see happening. Talk to us about that process. How do you go about then building a strategy based upon your thoughts on the economy?
So it's a little bit disconnected, but they are connected. Again, understanding that the market will lead the economy ultimately is key to translating economic forecast into an investment strategy. As you know, as a trader, if you're just let's just talk about the technical trends of the markets. You know that when the market is trending positively, we want to participate in that trend. If the markets are trending negatively, we don't want to participate in that trend to the downside. I mean, we can short the markets, that's great, but primarily we want to be in when the markets are bullish. We want to basically be somewhat out of the markets when they're not being positively biased anymore. Or in other words, you're in a bear market. So understanding that ultimately the economy is going to be reflected back into the market, and the market is going to pull that as a lead relative to the economy. Oh, one thing here this is an important point. Talking about the economy, understand that the economic data points today, 3.5% economic growth for the third quarter, is not going to potentially be 3.5% economic growth a year from now, because economic data is revised in arrears, and every year the BEA comes out, revises their economic data for previous years. Every 3 years, they do a massive revision back to a decade or more on what the economic data now shows. And this is why in December of 2007, I wrote an article that said we are about to be in or already in the worst recession since the Great Depression. Nobody believed me. The market was still doing fine at that point. And of course, in December of 2008, the National Bureau of Economic Research, which is the organization that actually dates recessions, came out and said, oh yeah, that recession started a year ago in December of 2007. So the problem, and this is why the market tends to lead the recessionary periods in the economy, when you look at economic data on a historical basis, that's all revised data. The data that we're looking at today has not yet been revised. And there's a very real possibility that a lot of the economic data that we are looking at right now, particularly when you look at, again, retail sales, auto sales, housing sales, the numbers you're looking at today are going to be negatively revised in months ahead. And the market, now back to the market here and the technical trends of the market, the technical pinnings of the markets are now starting to suggest that that is indeed going to be the case, that the economy is indeed weaker. And the markets are starting to sniff that out, both in terms of earnings, expectations, et cetera. The market's telling us that that data may very well be much weaker than we currently believe. So this is why when we take a look at a technical basis, we don't use a lot of daily analysis in our work. We manage money for clients that are retirees. They're conservative in nature. They can't afford to lose a lot of money. So we don't do a lot of daily analysis because we're looking for the trends of the markets. We need to keep money invested and growing as markets are growing. We need to be out of markets primarily when markets are declining. And to reduce volatility and to reduce whipsaws in our positions, we use a lot of weekly and monthly analysis to slow that volatility down. Again, for us, we're not trading markets, we're investing. We're long-term investors in the markets. We're wanting to identify risk and trends. So we use weekly and monthly data to identify those trends so we know when to increase or reduce our allocations to risk.
A couple of things. Quickly, if you could, just explain to everybody why these numbers are revised the way that they are. Why can't they just come out accurately at the time? I guess I don't understand that.
Well, China does this. See, so at the end of each quarter, China reports their numbers 15 days after the quarter, and they say, that's our number. And that everybody believes that China is absolutely right, that their numbers never need, and they never revise their data. They come out, if everybody believes that 6.5% growth is going to be their number, magically they come out and say, yeah, our GDP growth was 6.5%. The reality is that economic data doesn't work that way. It is not sloppy. It's not clean. It's very sloppy. It's a guesstimate. The first GDP number that comes out. So each quarter we report GDP 3 times.
Yep.
The first analysis, the first quarter, the first month of the quarter when we report, there's no data in yet. The Bureau of Economic Analysis goes around to all the blue chip economists and say, what do you think growth is going to be for this quarter? And they say, well, I think it's going to be 3.2. I think it's going to be 3.7. I think it's going to be 3.4. They average them all up and say, well, our first estimate is 3.5%. There you go. It's just a guess of a bunch of guesses. The second month of the quarter, they have some of the economic data has now come in. So they start pulling that little bit of data together and they start revising the original estimate to the original estimate and this revised data that's coming in. And by the third month, there's more data that's come in. It's still very guessy. A lot of this data is still guesses and early estimates. And a lot of these surveys that come in, they're emotionally based surveys as more so than actual hard data economic surveys. So it requires literally to look back at this data and say, this is really what the data did. This is really what happened in the economy, which is why we have these annual revisions to the data.
Yeah, I mean, I'm a simple man, Lance. As I look at this and go, it's like, why are we putting out guesses like this far in advance? But hearing it from you, I understand that. So it takes the full year to get all of the data and to get a real number. So right. I want to talk about execution. We talked about how you look at the economy, how you strategize. You talked about your time frame. You have a longer term time frame, so you're using weeklies and monthlies for a lot of your data points. Talk to us about some of the technical analysis tools that you're using and why you're using those.
So in terms of technical analysis, I am a pretty simple technician, right? Technical analysis. I'm not a technical firm, right? So in terms of our technical analysis, we use technical analysis again to identify trends of the markets. Again, I'm not swing trading positions. If I was doing that, my technical tools would be entirely different. What we're using right now is that, again, we use weekly and monthly trends, and we use a kind of a KISS principle to our technical analysis. So we're looking at data, we're looking at technical trends of the markets. So, we're looking at moving averages, we're looking at, previous points where the market have either broken up or broken down. And then we're looking at some basic overbought, oversold indications to try to determine at what points we're likely to see an acceleration in either buying or selling. And again, what we attempt to do with technical analysis is to be more timely about what we buy. So fundamentals, when we buy an equity position, we're looking for strong, fundamentally based companies with strong return on equities, lots of free cash flow, dividend yields. The basic fundamentals of saying this is a good company to own. I'm like Warren Buffett. One of the lines that Warren Buffett that's often misquoted is that my favorite holding period is forever. And everybody assumes that he says that he just buys something and he sits on it forever. He's never going to sell it. That's not what Warren Buffett means. Warren Buffett regularly sells positions that are no longer of value or have changed in their direction, et cetera. What he means by that is that my favorite holding period, and mine too, is forever. If I could buy a great company and hold it forever, I would. But fundamentals tell us what to buy, and they also tell us when it's no longer of value. But what technical analysis tells us, and again, in June of this year, when markets were nearing all-time highs, that was a opportunity that I could have bought something, right? There are companies to buy all the time, but the technical analysis said, hey, you know what? The markets are way overbought. They're very extended here. We're going to have a better opportunity to add positions to portfolios at a better price when this overbought condition is worked off a bit. So while fundamentals tell us what to buy, technicals tell us when to buy it or when to sell it. So that is where we really kind of drive down into technical analysis for us, which is helping manage the risk of exposure and the risk of mistiming an investment into a position. I can buy a great fundamental company at the wrong time and lose money. So that's what we want to try to avoid. So we like to look at weekly trends of moving averages. We like, particularly in particular, we like moving average convergence and divergence indicators, as well as Williams percent R, which is basically the inverse of a stochastic indicator, to help determine when markets are on buy signals, when they're overbought or oversold, and what the trends of the markets are overall. And when those trends or things begin to reverse, that's when we start looking for opportunities to reduce exposure to the markets and not panic. And that's the other value here of technical analysis, that when markets begin to enter a sell type mode, which we saw in October, it's very easy to get sucked into that panic and selling at the wrong time, selling at the bottom. We don't want to do that. So by looking at oversold conditions of the markets, we're looking for that period where we get at least a bounce back. And it tells us, hey, markets are extremely oversold. We're 4 standard deviations from a short-term moving average. These conditions historically don't last long. We're likely to get a bounce, and we want to use that bounce to lift equity into. So it not only helps us on the entry, but also on the exit.
I think I've got the whole picture here now. But can you take us through a recent example from soup to nuts, from your economist hat to your strategist hat, and then you go into technical analysis?
Sure. So let's go back to December of 2017 for a moment. This is the best example of how this kind of all came together. So in December of 2017, we passed the tax reform bill. And I started writing a series of articles about the impact of tax cuts, what that was going to mean for the economy, how this was really going to work, because the way the tax cuts were passed, they were not going to benefit the bottom 90% of the economy. This was all going to be swept up into the top 10% of the economy through those people who actually had money invested in the financial markets. So basically the premise was no real big economic boost outside of what we saw from hurricanes and natural disasters. Lots of benefit for corporations and C-suite executives, which is exactly what ultimately came to case. But in January, we saw the markets just go ripping off, and we had this massive run in the month of January. And at that point, we began actually reducing exposure to the markets. Why? Well, because first of all, our economic underpinnings didn't support the run up in January. That was strictly a sugar high developed from the idea that we're going to have this massive increase to bottom line earnings per share for corporations. Markets got extended above the long-term upper trend line. So if you go back in the markets and drew a line across the tops of the markets going back to 2015, 2016, we broke out above that and got extremely deviated above the long-term moving averages. We were pushing 3 and 4 standard deviations above the moving averages. So, and again, if you think about moving averages as gravity, so to speak. What a moving average is the average price over a period of time. And of course, that is where prices, in order to have an average, prices have to trade both above and below that price during a period of time in order to have an average. This is why 80% of all drivers can't be above average. So it's what averages do. They're like gravity. So when prices get extremely deviated above that average, you or below, you're going to get a reversion back to the mean. Right? So this was simply, we're looking at this, technical says, hey, this isn't going to last. And then we began looking into, okay, economically, what's happening in the rest of the world? So in the rest of the world, we're seeing a slowdown on the global side. We're seeing this impact really in the U.S. It's very isolated. So we made a decision in late January to get rid of, we reduced all of our exposure to international emerging markets. And then because of the trade war rhetoric, we also exited out of all the basic materials and all of our industrials. So because that was going to impact the earnings for both basic materials and industrials. And of course, trade war wasn't going to be good for international and emerging market economies. So removing that exposure from the portfolios helped mitigate a lot of the downside risk that we've seen over the course of the last several months. Of course, then the markets corrected in February. We had that big sell-off, but we never violated the 200-day moving average to any great degree. We never broke it on a weekly basis, and we traded below it very temporarily, but immediately recovered above it. There was buying that came into the markets. And using our technical analysis and looking at, again, deviations below our moving averages, looking at our overall trends, the longer term trends were holding in place. So as markets came down and retested those lows and then moved up and broke out, and we started stair-stepping up over the next several months, we added some exposure to the markets along the way. increasing our allocation to risk. And so that is a dynamic. And again, the only reason we were allocating more to risk was simply from the function that markets were rising, had nothing to do with the economic outlook for the market. We'd already solved the economic equation because of trade wars, tariffs, and those risks by removing international emerging markets, basic materials, and industrials from our portfolios.
I love it, Lance. Great stuff, my friend. Thank you for sharing that whole process with us. We're not done yet, so we have some rapid fire segment questions if you're ready for those.
Absolutely.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Access the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. And now you can trade cryptocurrency spot and derivative markets side by side. For more information, please visit tradingtechnologies.com. Lance, what trader has influenced your life the most and why?
From a trading perspective, I would probably say it's Paul Tudor Jones. I'm a big studier of investors throughout time, whether it's Ben Graham or Peter Lynch or a variety of others. I really look at and focus my studies on people who've been successful over time in a variety of markets. But when he gets right down to it, Paul Tudor Jones is probably one of the best at actually navigating markets and doing very well. And of course, I regularly post his rules of trading. One of the biggest rules that always jumps out to me is never average down in stocks, right? Losers are losers for a reason. And this is one of the hardest things for people to get over in terms of trading portfolios is they say, well, if you loved it at 50, you got to love it at 20. No, it's a loser stock. It says you were wrong. You've got to get out of it, move on, find something else to invest in. And so those basic rules are why, and they are the foundation of how we manage money and the rules that we follow. We have to remain unemotional as an investor. We can't get tied up into these psychological issues that lead to long-term poor trading. And so following a good, solid set of rules is key to doing that.
What was one of the hardest things for you to overcome in trading the markets?
Selling losers.
That good old competitive spirit.
Yeah, well, it's the function that nobody wants to be wrong. Nobody wants to admit they're wrong. And the hardest thing for any trader is to sell a loser because it's an admission that your thesis, your theory, whatever it is that got you into that position was wrong. And admitting you're wrong is always the hardest thing to get over with. And so learning to sell a loser, regardless of where it is or when it is, and that's still the hardest challenge that even I have today is still selling a loser. But it's just one of those things you have to do.
We talked a lot about your process today, Lance. How has your process evolved over the years?
One of the biggest changes over the years, so I've been managing money since prior to 1987. So went through the crash of 87, went through the crash in 2000, went through the crash in 2008. And it's always interesting to me because when I write articles about long-term investing and these type of things, I always get lots of pushback from people that have never seen a bear market. 13.3 million freshly minted financial advisors since 2009, and a tremendous number of people that are invested in the markets today have actually never been through a bear market. So it's always interesting to get the pushback that, these markets always go up over time, just buy and hold. And the issue that has evolved for me over time has really not been such a case of did I change my technical analysis any or did I change my economic analysis, but it's how I manage clients. In 2008, this is an example, in 2008, we completely moved out of the markets in June of 2008. The markets were already down about 8%, moved out of the markets completely, and of course the market then proceeded to crash through the rest of 2008. When in February of 2009, I wrote an article called 8 Reasons for a Bull Market and started buying into equities, and I lost $50 million worth of clients. And the reason was because you've got to be crazy. Haven't you been listening? This market's going to zero. And so the change to our management style is that now we never move completely out of equities. We now maintain what we call a core section of equities. It's about 12.5% of the portfolio that we can then go short against, and we can completely neutralize or even go, or completely go negative to in the markets But by maintaining that core position, it allows for clients to better navigate turns from being a seller to being a buyer. So that's been the big change for us, is actually how to manage client psychology more so than actually managing portfolios.
What is one attribute that you believe every trader should have?
Discipline. The biggest mistake that I make still today, and look, nobody's perfect at trading. Nobody's ever going to be perfect at trading. You're always going to make mistakes. But the most important aspect that you've got to have is being disciplined to a strategy. Whatever it is, you've got to adhere to it. The mistakes that I still make today are only when I deviate from my strategy. If I adhere to my strategy and I follow all my rules, I generally win more than I lose. Whenever I lose, though, primarily 99% of the time, I go back and look and say, why did that go wrong? It's because I deviated from a rule, either emotionally or client-driven, whatever it was. But the biggest issue for success over time is being disciplined to a strategy.
Favorite book you've read about trading?
Oh, gosh, there's so many. Greg Morse, Trading the Markets.
What's your favorite movie about trading?
Wall Street, of course. Both 1 and 2.
What's the best piece of advice that you've received about trading?
This is a podcast, right?
Yep.
Okay, so the best piece of advice about trading was from an old friend of mine who I've been working with for about 20, 30 years. He says, trading is a lot like golf. He says, there's 3 rules to being a successful golfer. And I said, well, what are those rules? He says, keep your head down, keep your head down, keep your head down. Same goes for trading. When it comes down to your discipline, it's about keeping your head down, and staying true to your discipline.
Now, if you could go back in time and give the younger you a piece of advice, what would it be?
Keep your head down.
Last question for today, Lance. Favorite thing to do when you're not working?
Well, no, it's not keep my head.
Tell me it's golf.
No, it's not golf either. I'm in Texas, so one of our favorite things to do in Texas is we go shoot guns a lot.
Lance, this was great. Thank you so much for joining me. Where can people find you on Twitter, and give us a website to check out?
Twitter at Lance Roberts, easy to find there. And of course, our website is realinvestmentadvice.com. And of course, we publish stuff there every day. By the way, one of the things that has made me a much better trader over the years is when I started writing every single day, because we write our strategy. We write about what we're doing. We relay that, and it holds us accountable for what we're saying and what we're doing. So one of the best things, a piece of advice that I can give to somebody who's just starting trading, is write a journal of everything you do. It keeps you honest.
Lance, this was awesome. Thank you so much for joining me on Futures Radio Show today.
Absolutely. Love to do it anytime.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.